Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today we're discussing inheriting an IRA, your options, and the law. We're going to be discussing in particular the basics of IRAs, the difference in rules between inheriting an IRA as a spouse as opposed to a non-spouse, some basics about the required minimum distribution calculations, and a few special rules for Roth IRAs. The Employee Retirement Income Security Act of 1974 created individual retirement accounts. These were meant to give an alternate private option to traditional employer pensions by giving employees tax-deferred earnings that could then be used in retirement. Today, there are many types of IRAs, including various types of traditional IRAs like SEPs and Simples, as well as Roth IRAs. But only traditional IRAs have required minimum distributions that start when the account holder turns 70 and a half years old. If a spouse inherits an IRA, they have two options. They can treat the IRA as their own, or they can treat themselves as the beneficiary of the IRA, in which case they would be subject to the same rules that all non-spouse beneficiaries must follow. Spouses who treat the IRA as their own are not required to make a minimum distribution in the year of death. They roll the IRA into their own account under their own name and then follow normal IRA rules. For example, they would be subject to a 10% penalty for an early withdrawal. Spouses have the options of either taking a distribution when they themselves turn 70 and a half, paying down the entire IRA balance over a period of 5 years, or taking a lump sum distribution at any time. Beneficiaries, as well as spouses who elect to treat themselves as beneficiaries, are not subject to the 10% early withdrawal penalty. They can make a trustee-to-trustee transfer to a newly created inherited IRA account in their own name. However, no new contributions can be made to such accounts. Beneficiaries have the option of either taking a distribution by the end of the year when the decedent would have turned 70 and a half, paying out the balance over 5 years, or taking a lump sum. Traditional IRAs must be paid out once the owner reaches 70 and a half years old. Each year, a minimum distribution is calculated based upon the remaining balance divided by an estimate for the remaining life expectancy of the owner. If the original account holder dies before they turn 70 and a half and are required to make required minimum distributions, then the RMD calculation for the beneficiary varies depending upon who inherits the account. For spouses, the RMD is based upon the spouse's life expectancy. Beneficiaries use their own life expectancy. Trusts use the life expectancy of the oldest trust beneficiary. If no beneficiary was designated, the 5-year payout rule applies. It's also important to note that if a required minimum distribution was already required on the original account, because the original owner had already reached 70 and a half, the rules are slightly different. There are special rules for Roth IRAs. The 10% penalty does not apply regardless of the situation. Roth IRAs have a 5-year vesting period. If a Roth IRA is inherited prior to this period kicking in, then distributions become taxable, but only the earnings must be reported in income. If you have questions or need help, call the tax experts at AA Accounting. We're available year-round to assist you. We offer various retirement planning and retirement account options. Call us today to set up an appointment with Bart or Teresa and start saving for retirement.